talk about decay or erosion today. I just saw the Jay Petruccelli interview, or I saw it last night, and man, it got me fired up. That poor guy had to explain 100 different ways that when the ETF drops, because the stock drops, the ETF drops also, of course. All ETFs drop, bullish ETFs, they always drop when the market drops. That's not decay, that's the market dropping. We call that delta risk or principal risk when you trade options. But just like when Jerome Powell retired the word transitory, I believe it's time to retire the words decay and erosion, at least as far as the Yield Max and Defiance families go. This is Max Convexity, and welcome to my outdoor office here in Austin, Texas. All right, so I'm going to start calling it drag, and I'm not talking about story hour. To me, decay and erosion is what the UVXY does. And of course, decay is worse in funds that buy options. And of course, the TSLI is a net seller of options. So that's another reason it doesn't decay. It can't decay. It actually is using decay in its favor. I think it's more accurate to call it tracking error. Here's an article from Morningstar that explains tracking error pretty well. Now, tracking error is what happens to indexes that are passive, that, you know, like the SPY or the Qs, when they lag just a teeny bit, a couple of hundredths of a point behind their benchmark, behind the SPX or the NDX. But in actively managed funds, the tracking error can be larger, because an active managed fund, the manager is trying to actively beat the market, so he's making more of a long shot type bets to try to outperform the market. But you can tell how well the manager is by looking at his tracking error, because there's positive tracking error too. Right now, I guess Petruccelli's has some negative tracking error on Tsly. I think the problem is you have to have enough time to allow the law of averages to work itself out. Just because you have an advantage in a trade, just because a trade's a winning strategy, doesn't mean you're going to win every time you do it. Look at the dogs of the Dow strategy. That was a good strategy a few years ago, where you bought the highest performing dividend stocks from the last year in the Dow, and the theory was they were the highest value stocks, and they would perform the best in the next year. And I think that does have a pretty good, compound return rate over the years. But it doesn't mean it wins every year. Wonder if somebody did that strategy in, I don't know, 2008 or something. I mean, is it the strategy's fault, or did the market go down? The market's going to go up and going to go down. You can't do anything about that. Petruccelli can't do anything about that. What he can do is he can earn a premium by selling options every month, or every week, and that's exactly what he's doing. I think he's doing a good job. I'm sorry to rant a little bit about it, but these funds don't erode, they do not decay, they do the opposite. And they're going to accrete, and they have been accreting. Check out these other two funds, JEPI and JEPQ. These are the JP Morgan covered call funds, and they're a little bit different, but they're very similar strategies, selling calls that are 2.5% to 5% out of the money. Pretty basic strategies. They're also, JEPI is trying to track the SPY, JEPQ is trying to track the triple Qs or the NASDAQ. And they're doing a pretty good job, and you can look here at this chart, and you can see that they aren't eroding. They have some tracking error. It looks like JEPI has a little more tracking error than JEPQ, but that's not erosion. Like I said, erosion's what UVXY does. If you ever want to know what erosion is, look at UVXY. So whenever people say that TSLY is eroding because it's down 2%, even though TSLA was down 3%, of course, that's not erosion. That's the fund working the way it was designed to work. It would be awesome if somebody could invent a fund someday that could go up as much as the market does, match the market's performance over time as far as price appreciation goes, and then also kick off this 50, 60% dividend like these guys have been doing. Of course, that's not realistic. I think what these guys are doing is good enough. Even if it's true over time, these strategies underperform just owning the stocks long. They give you a ton of other advantages as far as taking volatility out of your portfolio and giving you more steady returns with the option income. it's almost like you can almost annuitize your retirement if in one of these funds. You may not, you definitely don't want one of these funds when you're 20, you know, when you're 50, when you're 60, it's a different situation. You know, I have an idea. So how about for every 1,000 shares of Tesla that somebody owns? This is not financial advice. Don't listen to guys on the internet, but every 1,000 shares of Tesla somebody owns, why don't they buy 1,000 shares of this? What that would give you about $250,000 worth of Tesla, and about a $270,000 portfolio. But $250,000 of that would be Tesla that would be unencumbered by options and able to go up, you know, as much as it can go up. But that the other $20,000 that you have, or just about $24,000 that you have in the TSLY, of course that's paying about 60% dividend right now. So that would make your effective yield for your portfolio, for your Tesla position, which is a $270,000 position, it will make your effective yield about 6%. And that's not a ton, but heck, to have full upside in Tesla and 6% dividend yield, I mean, you know, it sounds pretty good to me. You have a built-in advantage when you sell an option, given the fact that you win 2 times out of 3. But it doesn't mean the built-in advantage is going to play out right away. In fact, it won't play out right away. Time is your friend when you use these types of strategies. Petruccelli knows this. He has all the numbers, and he's doing this for us. You could do this yourself. If you don't think Jay's doing a good job, go over to Tasty Trade. Those guys are experts at selling options. They can teach you everything you need to know about selling an option a million different ways. They've never met an option they didn't want to sell over there. But go do it yourself. It's not that complicated, but I think you'll appreciate what Jay's doing a lot more. It's never an easy decision when to roll or not. I remember one time I was $28,000 underwater. I'd sold calls and my stock went up and went through the roof, and I had a $28,000 debit looking at me. And I don't think there was anything available to roll. This is about 20 years ago. Anyway, I did finally find something to roll it to, and I rolled it way out, but it was just an absolute disaster. Yeah, I would have never sold the call had I known the stock was going to explode, but I'd been doing that for 3 years prior to that, and the stock never exploded. I made tons of money doing that, but not that one time. But it's not the strategy's fault that I lost $28,000. That's, you know, it's because I was selling the option. In return to sell the option, you have to take the principal risk. Anyway, I think people are starting to understand this in the yield max funds. I'm hoping so. You see more people on the internet that are starting to enjoy them, and I'm really excited about them. I really think the Defiance, especially, is the daily options are tapping into an untapped resource that I'm really pumped about. But I've been hearing so much stuff about TSLY that's just not right, and it gets me going. But, you know, this is reason number 1,000,000 that this is the golden age of option trading for the retail trader, because you don't even need to trade options anymore. You could just buy this ETF, and you can still make the money these option traders are making. I like to trade options. I like the complexity of it and stuff, but a lot of people don't, and I think this ETF is just great for them. The other thing I really dig about it is for years, only hedge funds, this source of income was only tapped by hedge funds and insurance companies that had billions of dollars, and they don't need more money, but they're the only ones that did these rolling put, or these put overwrites and these call overwrite strategies. They're the only ones that got to take advantage of it. Now that we're in the golden age of option trading, now that Tom Sosnoff brought us, Thinkorswim and Tasty Trade, and now that we have free commissions basically everywhere, and, you know, great software and great internet and, you know, technical and data and stuff, it's just a great time to be a trader, especially an option trader. There's no such thing as a guaranteed investment, of course. These funds are designed to harvest the volatility risk premium, and I think they're doing a pretty good job of it. The volatility risk premium is a certainty. That is there, and it's been there for hundreds of years, and these guys know how to harvest it, and they will get it, and they are getting it. But it doesn't mean the strategy is going to work out right away. These strategies are using math and statistics in your favor, and time is your friend on these. Anyway, thanks for listening, guys. This is Max Convexity here in Austin, Texas, and I'll be back tomorrow with another video. Have a good day.